This is Masters in Business with Barry Ritholtz on Bloomberg Radio.
This week on the podcast, I have a special guest. Steve Suttmeier has been in the technical analysis game for a long time. He is Chief Equity Technical Strategist at BofA Securities, and he is a double threat. He has both a CMT and a CFA, looks at the world from a very interesting perspective. I get BofA research, and in particular, I really enjoy Steve's monthly chart blasts, as well as his, overview. Every now and then, he'll do a deep dive into things like sentiment or sector rotation. I find his work to be very informative and very useful, and I think you will also. With no further ado, my conversation with BofA Securities, Stephen Suttmeier.
Thank you very much, Barry.
Glad
to be here.
Yeah, I'm glad to have you. So let's talk a little bit about your background. So you get an MBA from Fordham. What was the original career plan?
Yeah, so I went to Fairfield University undergrad, and it was right. I mean, put it this way: it was right after the 1987 crash. So I was there from '89 to '93, right? So instead of pursuing business, I pursued pre-med, and since my writing skills weren't all off the snuff, I just dove in and said, you know what, let me get a double major and do English writing. So I wanted to challenge myself, improve my communication skills, through the writing process. Long story short, get out of college, it was a tough time. It was the early 90s, and, it was hard to find, jobs. And I was not a good standardized test taker.
Right.
So my MCATs were bad, but I took them 3 times, but I managed to jump my score, right? So I still was able to get a few interviews at med school, but I kind of changed my mind on what I wanted to do. So, after so what I did was I was looking around for finance jobs, and obviously you're not going to hire, a pre-med bio major, an English writing major, right off the street, right? So I just answered an ad from the paper, and guess where I wound up? I wound up at the boiler room right across from Stratton Oakmont.
Oh, really?
In 1994.
What were you doing there?
I was one of those cold callers.
No kidding.
And, quite frankly, it was a very interesting learning experience. I was only there for a year and a half because if you've seen the movie Boiler Room,
sure,
I lived it.
Was that accurate? I mean,
their office was a lot nicer than ours, but generally speaking, was fairly accurate. And I remember when he was studying for the Series 7 in the movie, he's realizing, wait a second, they're doing things that are not right. And I'm sitting there like, man, I'm glad I'm not licensed yet, because the last thing I want to do is get booted out of the business before I even start. So
you know that scene in Wolf of Wall Street where DiCaprio sits down in the room and makes that first call. I worked with guys who were that good, but came from that same sort of background, and they all seemed to be too impatient to get rich slowly. But a lot of these things really resonate, really come across as that was a real thing in the 80s and 90s.
It was, and I just learned that the antennas went off, and I'm like, this is not where I want to be.
To say the very least.
And then the funny thing about it was when I see those movies, both Boiler Room and Wolf of Wall Street, the script that they're reading from is exactly the script that they gave us.
Whoever did their research, they found a bunch of stuff, and it was pretty amazing. So you leave that world and you go to a few boutique shops.
That's right.
You work at Capital Growth Financial and Informa Global Markets before you join investing giant Merrill Lynch in 2007. What was that transition like from smaller shops to a really, really big one?
Well, I mean, that's a great question. Let me just spend 30 seconds before answering that. I was lucky to have a dad in the business, so he didn't take me on, initially. And I had to go through kind of like that McDonald's thing, working the fries, at the boiler room kind of thing.
Right.
And then in 1996, I actually worked for him for a little while. And we went down to a firm in Florida. Then, I made friends with some people in the research department there. And that's when I started to focus on research. So first it was a hybrid technical fundamental, and then went to fundamental, and then went back to technical full time. So the reason why I went on to Merrill Lynch was, look, I was entrepreneurial. I worked for small firms that we could have built into a big business, but the problem was we were charging 4 cents a share, and that make a long story short, everybody else was charging 1 or even less than that, and we weren't able to compete. And
that makes a lot of sense.
It was very hard. So I'm like, let me get to somewhere more stable. big Mother Merrill in 2007.
Right.
Stable.
Perfect.
Little did I know what was going to happen 2 years later.
Perfect. Well, let's
Or
talk
a year and a
about
half
that.
later.
Let's jump ahead to a question I was going to ask you later. You joined Merrill in March of 2007.
Right.
On the verge of a cusp of an epic meltdown. What was that year at Merrill like? That had to be kind of wild.
Yeah, of course. I mean, it's just I just remember because I was a little bit more seasoned. I've been in the business 15, 16, 17, 14 years, 15 years when that hit. And I just remember the weekend of, the shotgun wedding, in 2008.
Right.
I just remember sitting down with some of my colleagues who were a lot younger, and they're like, what do we do? Right. I'm like, well, you know what? You do your job until someone says you can't.
Just keep your head down, keep working.
I mean, I've worked at other firms where they had layoffs like every few months, and, we knew when they were coming, and just like, you just do your job until you're told you can't. And that's that, I mean.
I have a vivid recollection of, what was his name? Thane was the CEO of Merrill at the time?
Yes, I believe so.
And I remember that wedding comes off and people were like really upset about it. And I was like, what are you talking about? He just saved the firm. How are you possibly, I'm sorry, your stock options are worth a lot less as opposed to zero? Something is better than nothing, right?
Well, I mean, look at the news on the weekend that weekend, seeing everybody taking boxes out of Lehman and Bear Stearns.
Right.
So it's like, yeah, it's very different. And
door number one was much better than door number three in the circumstances.
Yeah, I mean, of course, obviously after that, merging the two together, there were redundancies and things like that, and they took the opportunity to, at least in, on teams that were big, cut them essentially in half.
Right.
A lot.
Merge the two, take the people who they think are the top performers, but that's pretty typical in
that's the way
finance M&A, right?
That's the way it works.
How it goes. This just happened to be done so rapidly, there was hardly any time for planning. It seemed like everything was on the fly.
Yeah, so the biggest thing we were worried about, so I was working with Marianne Bartels at the time.
Oh, sure.
She was running the department, and the biggest thing we were worried about, we weren't worried in one regard because, B of A did not have a dedicated technical analysis team. But at the same time, we were worried that B of A did not have a dedicated you know what I mean? Because maybe
they may not appreciate the value of it.
But they did, and they kept us. They kept,
So let me roll back. I jumped ahead. What was it that you have a background as both a CFA and eventually a CMT? Given your background in fundamentals, what was it that attracted you to the technical side?
Well, I started off technical, which is unusual. Normally, it's the other way around, and. It was, my first research boss, his name was Stefan Haber. He worked at William R. Huff & Company. And he encouraged me to take the CFA exam. And I remember that first level was tough. I had no finance background. Accounting was very difficult. So
right, it's about a 50% fail rate, something like that, maybe even more.
I mean, the level one was, I don't remember at that time, but all I do remember was the first half of the test. I felt like, I failed it. So then during lunch, I guess I pulled the Harlem Globetrotters and regrouped and was able to get through the second part pretty easily.
Right.
So, but no, that's what turned me on to it. And, we had a very fundamentally oriented research group, and I was a technical analyst. So he kind of, brought me on as a hybrid analyst. And it was good. I mean, I learned a lot from when I worked there. I covered, the first stock I guess I was jointly covering with another analyst was J-Bill, which was based in St. Petersburg. So, so that was kind of fun. Yeah, so I got to learn a lot there.
So how do these complement each other? How do the fundamentals complement the technicals? And does one sort of dominate the other, or are you a technical analyst with a fundamental sort of in your back pocket, not what the key driver is?
No, my primary work is technical. In terms of fundamental, I rely on our analyst ratings at the firm. I look and see, what stocks they like, what they don't like, and I look at the charts, and if it melds with what they're saying, I go with it, or if it looks like it's going to turn in favor of what they're saying, I go with it, and vice versa. Of course, there's other times where I have a really compelling chart, looks bullish, where they have underperform on it. I'll publish on it. But I always say, hey, here's fundamental view's different. Here's the research note to look at that. So I respect the work that they do, and I try to I try to enhance it as much as I possibly can. So for me, though, technicals are always, first and foremost, because that's my role. But I mean, obviously, you want to own something that has some sort of intrinsic value. So I think that's the way I would probably think about it. More of a can slim type of approach, because I was always a William O'Neill fan, and he just passed away a few months ago. So that was kind of sad, because I have that book on my shelf.
As we all do.
As we all do.
Right.
So yeah, I mean, it is a. Yeah, I mean, I know in another world, if I was ever moved on to somewhere else where I was, doing, something in a smaller shop, I'm sure I would put that fundamental hat on a little bit more often than I do now. But I don't have to now, because I got a whole team of fundamental analysts that we rely on.
You're reminding me of the Ralph Acampora quote: "Fundamentals tell you what to buy, technicals tell you when." Accurate?
I mean, I love the quote, but I don't necessarily believe it's entirely accurate, and here's why. I think technicals can tell you what to buy as well.
Oh, really?
Because if you can see a price pattern, you can see a trend, and if a stock's building a big base, and say the analysts are 90% sell ratings, and a lot of volume is surged down, when the stock first declined to say $5 from 20, right? And then volume surged, and all of a sudden you're trading sideways for a long period of time on less volume. Your fundamental work saying, hey, wait a second, this seems to be undervalued, or maybe the earnings are going to improve next quarter or something like that. That's something I would look at to potentially buy, even though technically speaking, it's not very strong, but it is building a big base. And if the relative chart, because I do absolute relative work, if the relative chart starts showing outperformance versus, when compared to the absolute, meaning the market's corrected a lot, but this stock is starting to lead, that tells me, somebody may know something I don't. And I should, maybe build a position in that name. So I think technicals are helpful with what and when. In fact, I'm probably more of a what to buy than a when to buy type of guy, because, look, I have to put out a research note, and it's like, I can't just say, hey, buy this name here at this price. It may never hit it. So I just kind of say, hey, here's something that looks attractive technically. Our fundamental analyst has either a buy or sell on it, but technically it's attractive. I think it's a stock to buy. And you know what? I would put the levels in there. If it hits these levels, then it becomes, more time to buy. But either way, I'm building a position there, based on my research.
So your title is Chief Equity Technical Strategist. What is a day in the life of the Chief Equity Technical Strategist at a big shop like Merrill look like?
Yeah, so B of A, when we, it's a combined hybrid role, right? So we service the global private clients, so the financial advisors are, a big part of what we do. We talk to them a lot. I do a weekly webcast on Wednesdays for them, 12 noon. You go on the road, you see offices, they ask you questions about markets, stocks, things like that, and you try to help them out as much as you possibly can. There are some financial advisor teams that have me do webcasts for, clients, periodically, sometimes quarterly, sometimes monthly, and sometimes just internal, just so they can, because one thing financial advisors say about the research that we put out on the technicals is that I may not be a technical analyst, but when I read, B of A technical research reports, it gives me something intelligent to tell my clients, especially when times are tough. And even if they're not using it other than that purpose, I mean, that's a victory right there.
Right. No, that makes a lot of sense. So let's talk a little bit about how technicals work. And I want to start just by asking, how do you define technical analysis? I've heard lots and lots of different definitions. What's yours?
Yeah, it's a great question. I mean, I'm sure it's changing as days go by, but for me, I mean, we're using mathematics, quantitative methods to identify and spot trends and patterns in the financial markets. I guess that keeps it pretty simple. So for me, it's really just trend following and pattern recognition. I will occasionally throw in second derivative type of indicators of price, like an RSI or
relative strength indicator.
That's right, relative strength indicator. Generate overbought, oversold, but it also involves things like breadth, sentiment. I do a lot of credit market work too, just looking at credit spreads and things like that.
So let's define our terms along the way. When we talk about breadth, we're talking about the numbers of advancers versus decliners. Is it a broad market or is it a narrow market?
Yeah, and that's one of Bob Farrell's 10 rules to remember. Markets are stronger when they're broad and weaker when they're narrow. So, again, ways to measure market breadth would be the advanced decline line, as you just mentioned. Also, new 52-week highs, new 52-week lows. You can also use 4-week lows, 24-week highs and lows, things like that. The other things would be diffusion indicators, like the percentage of stocks above moving averages. So if you have, interestingly, if you have the S&P, above a 200-day moving average yet, fewer than 50% of the stocks are above it, that kind of tells you something about breadth of the market. The market's stronger, but more stocks are below the moving average. So, I think that's something to look at. So some of these indicators, like the percentage of stocks above 10-day moving averages, can also be used as momentum. So sometimes you can use breadth as a momentum. So the other thing I mentioned was sentiment. So that basically is sentiment and positioning, lump in positioning as well. So if you're watching sentiment, it's the surveys. The Investors Intelligence Survey, bull, bear, and correction. And then you got AAII, bull, bear, and neutral. You have, so those are sentiment indicators. What are they telling us? What investors are doing. Now, hopefully investors are saying, what investors are saying, right? Not doing. Hopefully what they're doing is close to what they're saying. That's what sentiment implies. But then you overlay that and look at something like a put call. That tells you more what they're doing. The volume of puts are higher than the volume of calls. That goes above 1. That means investors are fearful. Another one I look at that I find very useful for tactical lows in the market, but sometimes more meaningful and tactical, would be taking the 3-month VIX, the volatility index, and dividing it by the 1-month VIX. So when that is high, like 1.25 or above, investors are like, I'm not concerned about volatility in the immediate future. I'm more concerned about it, later on. But when that goes below 1, that means the VIX is higher than the 3-month VIX. So investors are more concerned about volatility now, which means they're more fearful. And when you have that set up, the market is often closer to a low.
So that everything you've just described is a loaded series of follow-up questions you've given me. I want to talk about sentiment, but you mentioned Farrell, and for folks who may not know who Bob Farrell is, tell us a little bit about the legendary Bob Farrell.
Well, he was the dean of technical analysis at Merrill Lynch, for the better part of, had to be 40, 50 years.
Right.
He has his 10 rules to remember, and a lot
which, by the way, have become, almost biblical for a lot of people in markets, a lot of technicians, for sure.
Those are huge shoes to fill. There's no question about it. And if I mention any of these things, any of his rules to follow my research notes, it's like my readership doubles. You know what I mean? So
That's
it's
funny.
like, forget about him. Forget about me. It's all about him, right? I just kind of have to invoke that presence, in my job, I guess. Because some financial advisors actually, when, you see some of the commentary they write, the greatest compliment I think they ever paid me was he invokes Bob Farrell pretty well. And I know that's not 100% true because nobody can do that. Right. But just to have half of that, I think, is a compliment.
That's great. What other technicians do you admire? Who else in the business do you think does a nice job?
Look, I obviously I compete with a lot of guys that do good work, but going back to the day, some of the folks that have influenced my work the most, I would say. Initially, it was John Murphy with his book. I have the torn up dog-eared book, Technical Analysis of the Futures Market. That was, now it's called Technical Analysis of Financials Market. So I got an old dog-eared copy at my desk still. I would say Martin Pring, I learned a lot from, through his work.
Pring, oh really?
And, some good cycle stuff there. Momentum, I got his book on momentum, which I found very useful. And I guess a third one I think that impacted me quite a bit was Dr. Alexander Elder, who wrote Trading for a Living.
Right.
And what I liked about that was, there's a lot of market psychology, investor psychology in there, but also how to run trading systems based on indicators. And I think that helped me out a lot. And much of in that book has influenced the way I've thought about markets and picking stocks. As the equity technician, that's kind of what I need to do, is identify stocks that I think can go up or down, or at a minimum, underperform or outperform. And, I use some of the techniques that he put in there, in particular, like a triple screen trading system where you have your weekly time frame, but you make your decisions off the daily. But I managed to do it all on a weekly chart, because if you put 3 different moving averages on a weekly chart, you can look at, a long-term moving average and a short-term moving average and do it that way. Where you decline below the shorter-term one and hold the longer-term one. I generally view that as a positive for a stock and look to buy it.
So you're mentioning folks who've been around a while, like John Murphy and Pring and Farrell, and I took the class with Ralph Acampora. I know a lot of people back in the day who used to do their charts by hand every day. And now there's just so much computing power around. How has the computerization of everything changed technical analysis? What do we do with all this horsepower?
Well, I mean, it definitely can allow for more rules-based signals in some regard. It allows us to do things with a greater universe of stocks. And I think it is useful to have that. But when I first joined Merrill Lynch in 2007, we still had point and figure charts that we're updating by hand.
X's and O's.
X's and O's, of course.
Tom Dorsey, that crowd.
Yeah, I mean, Tom Dorsey, I believe Investor Intelligence also has a product on point and figure. I mean, very popular among the financial advisor crowd, but not so popular among the institutional crowd. Mm-hmm. The institutional crowd probably looks at it. It's like I'm looking at a letter from my grandmother with the X's and O's on it, right. And she gives me hugs and kisses.
It's a little imprecise. It's not as.
It depends.
It seems to be more general than.
I mean, you can make it more precise if you want to, but that requires a lot more effort and work. And with the computing power today, I think the one thing that's changed is, a lot of people can think they can pull up a Bloomberg and all of a sudden call themselves a technical analyst because it's just very easy to create these things.
I'm glad you brought that up, because I recall when I started on a desk in the 90s, if you wanted to put charts on a computer screen, you had to subscribe to a very specific package. Even the terminal back then, you couldn't do what you could do today. It's
right.
Light years ahead today. Kind of now, you go to any website and have unbelievable access to all sorts of technical studies. I'm curious, what sort of impact does charting software for free everywhere have on the practice of technical analysis?
Well, I mean, it's still a market where people will, trade and make decisions to buy and sell. I mean, I do look at stockcharts.com. I mean, when I'm on the road, that's very easy to pull up and work with. I mean, does it make it more of a self-fulfilling prophecy? Who knows? I mean, but I think it wouldn't negate, the one major thing that dominates financial markets. It's fear and greed, and maybe it accelerates that process a little bit more. Mm-hmm. I mean, the other thing, it's really not just technical analysis, but it's the availability of information and instant analysis.
Right.
Analysis can be done. I mean, just let's face it, there's businesses built on that premise where, you have high frequency trading where they calculate things in milliseconds. I don't even know, but you know what I mean. It's like really fast.
Nanoseconds. Right. Instantly,
probably the more accurate way of saying it, nanoseconds. So, I mean, it just makes things very quickly. And how I adapt it to it? I focus more on a longer term time frame, not like monthly, but weekly. The daily gets a bit noisy.
Very noisy.
Back in the day, it was intraday charts that got really noisy, but now daily charts have gotten noisy. I hope weekly charts don't get noisy because that would complicate things even more.
I'm curious if the 0-day options that expire every single day have an impact on trading and have an impact on charts.
Probably. I'm not sure what the impact exactly is, but I mean, I think just instant, instant, whatever the term is, I can't even know, but just instant information. I mean, it just makes things more volatile, generally speaking. You wouldn't know by looking at the VIX, but you look at like intraday price action, day-by-day price action. It's like you got stocks that have multi-billion market caps that are moving like 2 to 3%, within the span of 15 minutes. I mean, that's a lot.
Wow.
I mean,
you mentioned fear and greed. Tell us a little bit about how you can use technical analysis to look at sentiment.
Yep. So A lot of different ways. First and foremost, I mean, you got the surveys that we talked about earlier. You got the book haul ratios. You got the VIX.
Let me interrupt you and ask you about the surveys, because I always find that what people say they're doing and what they're actually doing on those surveys don't always seem to line up.
Right.
And they seem to spend most of their time in a sort of no man's zone where there's no signal. It's at the extremes when they're useful. How useful do you find sentiment surveys generally, where we're asking people, how bullish are you? How much equities do you have? How much bonds do you have, et cetera?
Yep. I would say it's more useful in calling lows than it is in highs. Because when you think about a low in the market and fear in the market, there's more urgency. Complacency, by definition, is not urgent. So that's why I think sentiment surveys work better when bears surge above 55, 60%, which is where they stood September of last year.
Complacency is not urgent.
It's not.
That's a great sentence.
Yeah.
I always think of it as it's hard to identify when people kind of get bored and stop buying, but it's easy to see when everybody's panic selling.
Exactly.
Right?
And that's what sentiment shows you. You see it on the put calls. You can see it also in futures positioning.
What are you looking at in futures positioning in order to identify a bottom?
Usually it is aggressive shorts from leverage funds on S&P futures, and
Are these professionals or are these punters and amateurs?
No, they're professional. But even professionals can form a crowd and a herd. I mean, that's the point of the indicator. That's the reason why there's a hedge fund clients that you visit outside New York City. They want to avoid the herd, right? But the other factor is asset manager positioning. Those are the smarter. I view them as smarter. So when they're oversold, the market's usually down as well. But when the market starts to bounce, they start to go with it. And they hit their lows, 2 of them last year, one in June and one in October.
Right.
And it was great. It worked out really well using that sentiment indicator. So I think there is still use for them. I will admit, though, sometimes I do wonder whether sentiment becomes more of a momentum indicator, which I think makes sense, because let's face it. I mean, if the market rallies 15% and the asset manager is still here and not buying the rally, then something else is happening.
Right.
So sentiment does need to turn into momentum, meaning that sentiment needs to start to confirm price action.
Can everything be charted? I mean, we're talking about sentiment. We're talking about trend. What about things like fundamentals? Can you chart the rate of change on earnings? Where do you draw the line of, hey, technicals aren't going to help you there?
No, I'm sure you can. I mean, I haven't done that much work. I mean, a PE ratio, you can chart that. I mean, pretty easily and do analysis on that. I think it's probably more useful in economic indicators like the unemployment rate or the claims data. And we actually did some scenario analysis around that recently, just talking about, hey, what happens if the employment rate rises versus falls? What environment does the S&P work better in? And, the obvious answer is the obvious answer, right? So, but it's not necessarily true, because there's some periods of time where the unemployment rate does rise, where the S&P actually does rally. And there's other periods where the S&P does not. And I really, it depends on what your market tide is.
How do you think about intermarket analysis? Are you looking at the stock market is doing this relative to what the bond market is doing? How important are looking across different, here's what the U.S. is doing, here's what's developed ex-U.S., here's what emerging markets are doing? How do you consider different geographies, different sort of asset classes? Do they interrelate at all?
I mean, I think they do. I think we've seen that over the last year or so. So here's the way I'm looking at it near term, not making any sort of forecast or anything like that. But last year, where we stood, market was very nervous. S&P around the 200-week moving average, finally started bottoming out. But what was the ingredient to get that low in the market? It was the dollar topping,
peak inflation.
Yeah, that happened, I believe, in June of last year.
Right.
And that's helpful. Also, yields topping out as well in September, October last year. So there's a negative correlation between the dollar and between stocks, the dollar, and bonds. So meaning, higher interest rates, lower stocks, higher dollar, lower stocks. That's been the trend. So the S&P rallied from last October, ran into trouble this summer, which is when the dollar bottomed out and yields started to really rise again in earnest. And now here we are.
Oh, God, it was a massive surge in yields from August, September, October, and stocks went the exact opposite direction.
Yeah, have had a 10% correction, and, we'll see what happens going forward. But I would think, not that this is a prediction or anything, but if that correlation holds, and if the S&P gets a seasonal bounce, which normally is something that happens around this time of year, one would think that if this correlation continues to hold, that a seasonal bounce for stocks likely requires yields to be stable to lower, or the dollar stable to lower. And, we'll see how that plays out. But that seems to be the correlation, the intermarket correlation that seems to be, in my mind, the most important one right now.
So what do you think generally people misunderstand about tech?
Yeah, I think sometimes I get emails where they think I'm like a magician trying to pull a rabbit out of a hat. They're asking for something technicals can't do.
Right.
You know what I mean? They're like, look, if you give them a few good calls, they think you can predict the future, but we can't. We're just gauging risk and reward. And I think that's
a really good way to express that. You're looking at various patterns and setups to identify your best risk-reward setup.
And I think that's a big misunderstanding, because most people are of the mentality in the DraftKings world that, technical analysis is a good way to enhance their gambling habit. But what we're really looking to do is manage risk reward. I always tell hedge fund clients when I'm talking to them, a lot of them are long short, but they're like, here's how I would identify a core long. You first and foremost, you identify what your benchmark is. How are you measuring your performance? And you take your absolute price, and if the absolute price is trending up along with the relative price, that's where you look for core longs. And if it got good fundamentals there, even better. On the other side, weak relative, weak absolute, that's where you get your core shorts. And I tell them, where it becomes really interesting is when you have a stock that's been trending up for a while, but all of a sudden the relative ratio starts lagging, meaning that if I'm a fund manager at the end of the quarter, oh my God, Apple's up 15%. Oh, wait, but the market's up 20. I'm lagging. Then they kick that out of the portfolio, and guess what happens? The stock starts to form a top because of selling pressure, and the same thing on the other side. So it's like you
and to clarify, you're not saysaying this about Apple.
No.
You're just using as a random example.
As an example, not talking about Apple or a prediction there at all. But what I'm saying is, it's like you can find a time using technical analysis to say, you know what, I've been bullish this stock, but it's starting to lag the market. Maybe it's time for me to revisit my fundamental thesis, and that's good. That's useful information to somebody, because what I've noticed is when a stock in an uptrend starts underperforming the market, guess what? I haven't tested this yet, but the theory is, and if I test the hypothesis, and the theory, and this theory works, the theory is a weakening relative often precedes fundamental information that's less bullish than people expect. And I've seen it happen a lot. And on the other side, too, if stock trending down, all of a sudden the relative ratio is starting to improve. In fact, this is the environment now with the market correcting where you look for names like that, where the relative chart's improving, meaning that, oh my gosh, the S&P's corrected 10%, this stock's only down 5%. All right, why is that? Is there something going on fundamentally I need to look into? And that gets, the fundamental analyst thinking. And if I was doing more fundamental work, it would tell me, all right, I really got to look at these companies to see, hey, what's going on? Are estimates coming up, or are the revisions improving, or you know what I mean? So, I think that's how not only a good way to interact with some of the institutional client base, but also and private client base as well, but also just as a process, because technical analysis is nothing, without fundamentals. Technical analysis. Somebody once coined it lazy man's fundamental work. and
Free riding on other people's number cruncher.
Because think about it. I mean, if a stock's rallying, it's doing it for a fundamental reason most of the time. I mean,
and you may not know what it is, but
until-
you can identify the footprints in the charts.
I mean, think about where we were a year ago. 100% of economists calling for a recession, and the market rallies.
Past
20,
2
30%.
years, right? I mean, that's been ongoing, the calls for recession.
And guess what? I mean, guess when the market started correcting? When people started taking those calls off the table and calling for a soft landing. So, as the market was rallying, it was telling us something. And then as soon as the economists started confirming what it was telling us, that's when it corrected. So now we need to see what event that we're discounting now. And hopefully eventually, we discount it completely and things can, get a little bit better.
Really interesting. Let's talk a little bit about what's going on in the current market environment. We're recording this Halloween 2023. Where are we today? Are we in a secular bull market or bear market? Are we in a cyclical bull or bear? What's the state of equity markets and bond markets today?
Well, I mean, I keep it simple with those sort of trends. So, whenever we go on television, we always pull up the same chart, S&P 500, with a 40-week moving average and a 200-week moving average. The 40-week moving average, for those who look more at daily charts, can associate that with a 200-day moving average. So we gauge the cyclical trend of the market using the 40-week moving average, and we gauge the secular trend as the 200-week moving average. So when you have a rising 40-week moving average, which we do now, and a rising 200-week moving average, which we do now, the pattern is a cyclical uptrend or bull market and a secular uptrend or bull market. Where are we now in the context of that, given the 10% pullback that we've gotten since the July highs? It is a correction of that pattern. We are below the 40-week moving average, around 42.50. So
that's on the S&P.
That's on the S&P 500, yes.
What about how does the NASDAQ look?
A little stronger.
Stronger?
Yeah, I mean, so when we look at the NASDAQ 100, for instance, it is still, it just tested the 40-week moving average last week, and well above the 200-week moving average, so still stronger. If you look at relative strength charts, the NASDAQ 100 still has a stronger pattern than the S&P at this stage. Technology, the sector itself of technology still has a stronger relative chart pattern. It's been sideways, but in a stronger trend. And you look at the RRG on Bloomberg, for instance,
which is for listeners.
Go. Yep.
You get listeners. What does that chart show you?
Oh, it's a great tool. Actually, I think I use it a lot in my work.
RRG stands for
relative rotation graph, and what it's telling us now is that some of the cyclical sectors like financials, materials, industrials, they had a chance to rotate into a bigger leadership position and failed. And technology and discretionary and comm services had a chance to rotate into a more bearish leadership position and did not do that. So looking at that, it's like you just got to think about what is the risk here, to investors that are, looking to get more not participation, but more alpha in the market from a greater number of stocks. The risk is that doesn't happen if this pattern holds. The risk is that tech can continue to lead, comm services continue to lead, and these cyclical sectors can continue to lag since they weren't able to take on the mantle of relative leadership in the relative rotation graph. So they were not able to move into an uptrend. And
so industrials have looked like they've been on the verge for a while.
They have.
Hasn't happened. On the other hand, same with financials.
Financials, same thing.
Looks like, now there's some spread. Financials can make more money. Hasn't really happened. On the other hand, energy seems to really be cleaning itself up. What's going on in the oil sector?
Yeah, so that's the one cyclical sector that has started to work. In fact, it does look an awful lot like the pattern that we had for that on a relative basis, meaning outperformance off the relative low from 98 to 2000, and that relative uptrend continued.
98 to 2, like we're looking back 25 years, 20 plus years,
and it was a similar pattern that we have now, and it's maybe a third of the way through it.
Wow.
Because that if that continues, energy should be able to outperform if history rhymes.
Right.
The oil chart looks like it could be building a base. It broke out and moved back and retested some levels of support, but we'll see how that pattern develops. But it does have more of a look of building a base within an uptrend for that. So if that does work and oil stays stable to higher, energy should work to some extent. Obviously this week or last couple of weeks, there's been some M&A activity where some of the bigger names started to get hit a little harder, but it didn't derail the sector at all.
Huh, interesting. I couldn't help but notice that very quietly, a lot of cryptocurrency, most specifically Bitcoin, hit new 52-week highs. Nobody's talking about that really. What does that mean when not only a particular stock or asset hits a 52-week high, but it seems to be off the below the radar? What do you make of that?
Well, I can't talk about Bitcoin. I don't think I'm allowed to do that at BofA Securities, of course. We're seeing that in other areas of the market as well. No, it just means nobody's there. Nobody cares. And
is that bullish or bearish? If nobody cares that something's making a 52-week high, that might mean a lot more people could come into that space.
Right.
Forget Bitcoin. Anytime we're talking about
any type
a
of
quiet
asset,
52-week high.
It happened. I think it probably happened with the energy names not long ago. Coming off the lows of 2020. They moved up a lot. Oh, it's already up 30%. Well, it went up another 50% after that. You know what I mean? That's people actually have that argument. Mm-hmm. Oh, I missed it, so I'm going to wait for it to dip, and it doesn't dip. That's what happens in that sort of environment. When you start to see that happen. So I'm sure over the next few weeks there's going to be patterns developing in other pockets of the market where things that have been left. I don't want to use the term left for dead, but I guess that's the only term. It's Halloween, so I might as well.
Right.
Though they can rally quickly 20, 30%, and people will be like, oh, I missed it. And then 3 months later, it's up another 20 or 30%. That's the way those patterns tend to work.
You mentioned Halloween. What's the scariest chart you've seen recently?
What I don't like, there's one breadth indicator and I don't like right now, and it's just, hopefully.
What's the breadth indicator?
It's the percentage of stocks above 200-day moving averages. They had some bullish divergences in the summer, and they broke to new, year-to-date lows.
Mm-hmm.
Now,
and you don't like that?
I don't know. We have to let's see if they get back to oversold levels, but that's something that's a bit challenging, But again, I think it all has to do with the fact that the equal-weighted index has been lagging the cap-weighted index pretty much all year.
You're anticipating my next question. What does it mean when you have this divergence between the S&P 500, the way we think of it as market cap-weighted, versus the SPW, the
that's right.
equal cap-weighted? That divergence is about as big as it's ever gets.
And that is a scary chart when you look at it relative to the S&P. Scary because if the technicals work on this, there's still more underperformance coming for that. The pattern, meaning that if you look at the pattern going back a decade or more, there is a potential that the equal-weighted index is forming what would be called a head and shoulders top versus the S&P, the cap-weighted index. I hope it doesn't work because in our firm, we have strategists that want to see the equal-weighted work, and I think it would probably be healthier for the market if it did work.
It suggests that the market is relatively narrow at present, right?
Right.
If the cap-weighted is radically outperforming the equal-weighted, it means the biggest 20 stocks are the drivers.
Yeah, that's where you're getting your alpha. In terms of market breadth itself, the advanced decline line of the S&P went to an all-time high over the summer.
Should be bullish, right?
It should be bullish. And it gets worrisome in my world, when this lack of performance for equal weight versus cap weight leads to weakening breadth indicators, which is why that percentage of stocks above 200-day moving average seems scary to me. Now, I will say, when you look at the equal weighted versus cap weighted ratio lagging, lagging cap weighted, guess what period of time that happened in the past where the equity market was really strong? 1994 to 2000.
Yeah, right. That was all driven by the biggest tech companies at the time.
And also,
right?
I think pharma was involved in that too, and other large cap stocks. Here's the other interesting thing. You look at the S&P 100 index right now. It does appear to be breaking out from a multi-year bottom versus the S&P, meaning mega caps leading large caps. The last time I saw a breakout like that was 1998. I find it curious that that's happening and the equal weight lagging the cap weighted, because in the late 90s or the mid to late 90s, the Fed did hike rates quite a bit.
Right.
And then they took some off and then hiked into, 99, 2000 with this environment for these particular names. So it just seems to me with these particular, size fragments working better than others. So mega cap market potentially at this point, just looking at this, if it changes, I'll change. I'll change my view pretty quickly if it starts to change. But right now, I know a lot of people really want to see more alpha generated by more stocks, but there's a risk it doesn't happen. But I do think instead of being the Magnificent Seven, maybe it's a Nifty 50 because the OEX is breaking out.
Well, we also know how the Nifty 50 ended, so...
but it takes time,
Right,
it takes time, and a
does.
lot longer than people think. I mean, I'm sure people were calling for a bubble in 1998,
right,
and you had a huge run-up in
Irrational
2000.
exuberance, 96. You had a long way to go. You mentioned the Fed raising rates. Let's talk about the bond market. What do you see in treasuries and the fixed income half of the portfolio?
Well, I mean, obviously that's not my call as the equity strategist at
Right.
BofA, but when you look at the 10-year yield, the view is a secular rise in interest rates. And if I'm putting on my equity hat and I have to say, all right, what was the last time you had interest rates rising from, levels around 1%? I mean, here we went a lot lower during COVID, obviously, but mid-1940s, so 1946 into 66, a 20-year rise from about 1.5 to about 5.75 over 20 years.
It's about this, maybe a little smaller than the current range.
Right. The interesting thing is, I mean, if COVID didn't happen, where would your yield low be? It's either 2012 or 16. You know what I mean? So I mean, maybe this secular rise in yields is a little longer than people think it is. But I mean, again, the market did drop on the 10-year note yield to 0.3 on the 10 during COVID. So, and this is, when you look at the yield chart, it's like the fastest rise we've ever gotten. So if we are going to follow, that period in the 50s, I mean, right now, I think we're probably, I mean, if I'm looking at stocks and overlaying it with interest rates and just trying to think about how it most, where we are in that particular analog, it's probably late 50s, early 60s in some regard. We've been secular bulls. But what is not a characteristic of a secular bull? It's interest rates above 5.75, and it's inflation, surging again. We can't have that happen. It's very interesting when I get people asking me stuff like, when is the market going to get back to normal? I'm like, well, define normal. Well, interest rates need to be lower, 1%. I'm like, well,
that's not normal.
Right. And, I find out these guys have been in business.
Right? 5-6% is pretty normal.
I mean, the average 10-year note yield going back to 1920, if, looking at the data, is around 4.7
All right.
or so.
So we're a little elevated.
We're right there. We're right
but
there.
Not terrible, right? We're
Now,
kissing 5 as we record this. What's a quarter point between friends, right? It's not that's a couple of days of wild trading action.
Right. So look, you get a return on your cash, which is great. A lot of people have taken advantage of that. So the other factor is, when is that record level of cash going to be put to work in stocks? With people making 5 to 6% on money market funds, it's going to take a little bit more, which is by design. The Fed wanted people to take on risk with rates at 0, and now they don't want people to take on as much risk in some regard. So it's going to take a little more confidence, in equities, because you get your hurdle rates higher. So
that makes sense.
So that's the reason why I think we are moving into a more normal environment where we're actually getting a really normal type of correction rather than something that lasts only 3 to 5%. We're getting a normal 10% plus type of pullback.
You mentioned how COVID changed what the lows were in the bond market. There's a fascinating piece in The Economist this week about in the post-COVID world, sentiment data has, just gone off the rails. In fact, if you look at the bottom of the sentiment data in 2022, and I've been struggling with this for a while, worse than the 87 crash, worse than the dot-com implosion, worse than September 11th, worse than the great financial crisis, and worse than the COVID lockdowns. What do you make of this wildly noisy sentiment data?
So wait, which data points were? So the COVID ones.
I believe
worse.
it was the University of Michigan sentiment data.
And that it was worse during COVID than any other period.
No, 2022, it hit a record low, worse than COVID, worse than GFC, worse than dot-coms. Just unprecedented levels that we've never seen. The Economist is implying COVID just disrupted our sense of the world.
It probably did. It probably did to some extent. And I think, in 2022, you started. I mean, you're already in a bear market from peaks in 2021. Mm-hmm. You already had indicators topping out in 2021 in the middle of the year and then late in the year. So we were well entrenched with economists looking for, a massive hard landing at that point. So it would make sense that sentiment would be off the rails to some extent, given that outlook.
Makes some sense. You frequently use a phrase that cracks me up in your research. Let's discuss your indicators, the good, the bad, and the ugly. One of my favorite movies of all time. Looking at the world that's out there today, what's good, what's bad, what's ugly?
Right. So, yeah, we just wanted to be a little tongue-in-cheek with some of our stuff here. So we noticed that the percentage of stocks above 50-day moving averages on the S&P actually did not go to a lower low as the S&P went to a lower low just last Friday. So that has the potential to be good, maybe triggers a seasonal rally. Another indicator we threw in there was the, I think they call it the NAAIM exposure index, that around 24% versus oversolds in the low 20s. Mm-hmm. That's getting closer. So exposure among asset managers and market participants in equities is a lot lower than it was. So a lot of the, I always use the term, a lot of the froth has been blown off the cappuccino, mm-hmm. Over the last 3 months. So those are some, better looking indicators. I would argue that when you look at the Chicago Fed Financial Conditions Index, it's held in like a champ. So that's another.
What does that mean?
Well, it just means financial conditions aren't deteriorating,
mm-hmm.
To any great extent based on that indicator, which is an indicator I like to use. Credit markets haven't blown out either, so that's spreads haven't blown out either, at least on the
and there people were warning that was about to happen in the spring when Silicon Valley Bank
right.
and First Republic blew up. This is it. You're going to see credit markets go upside down, and that'll be it for equities. Not so much, right?
Not so much. The corporate BAA to 10-year spread is one I look at a lot.
Meaning investment grade to just below investment grade.
It's the 10-year spread versus that. So
right.
I'm looking at the lowest tier of investment grade versus the 10-year yield.
Versus the Treasury, gotcha.
Yep. And what I'm trying to say is, all right, when does stuff start to creep into investment grade, the lower tier? And it hasn't happened. That is well below 2%. And when you get above 2.5, that's when things really start to struggle.
Let's talk about your sector work. How do you utilize different sectors, and how does that work into your overall approach to macro?
Well, the sectors, this is I've been shying away from having bold sector calls this year. And the reason why is you can find bullish and bearish stock charts everywhere, mm-hmm. no matter what sector you're looking at. Even utilities.
What does it mean when a sector is strong and an individual company is weak? Is it just reflecting that company? How do you draw a conclusion from that?
No, what you want to see, sure, that's a good question. So, if you have a bullish sector, I would argue tech and comm services is still in quite bullish position. Mm-hmm. So if you have a stock and a bullish sector is not acting well, chances are it's an idiosyncratic problem with that stock or chart. Probably a fundamental reason for it too, more so mm-hmm. than a technical reason, because, the technicals are reflecting the fundamental situation to some extent. So I think right now, just looking at sectors and looking at, the way things look on the relative price charts along with the absolute price charts, it seems like, tech is holding in fine. Comm services holding in fine. Semiconductors trying to hold their trend. Industrials, trying, but not really convincing. Energy holding in just fine. Materials, it depends on the stock. You can find some winners, find some losers. And financials, it's really challenging because two things. One, the absolute chart looks okay as long as it can hold those prior highs from 2007, which it has done. But the relative chart, not okay. But within that group, you can find winners in things like exchanges and stuff like that that look really strong relative to the laggards of the group, which just happened to be, the sector near and dear to my heart, the banks. It's like, just
not because you work for a bank, just the sector you happen to really like, right?
I mean, why not? I mean, it's like it's you want to see your companies do well,
of course.
It's like
so. Let's talk about the macro. What goes into what you look at most when you're doing an overall view of the equity markets?
Yeah, so I mean, one of my favorite indicators, and I would lump it in with the good, would be the 73 country index of market breadth. So the advanced decline line for 73 country indices. The U.S. is one of those.
So it's not just looking at the domestic equity markets. You want to see the whole world doing well at once.
Yes, and that advanced decline line broke out during the summer. And even though the market correction has taken a lot of indices below their summer breakout points, this particular advanced decline line remains above its breakout point, meaning that there are pockets of the world that are working better than others, out there. So, yeah, I think that's important to point out. And so global breadth hasn't rolled over. So it tells us that we're in a corrective phase within what could very well be a market that may yet have another up leg to it, not just in the U.S., but also, globally.
So since we're talking about global, the world always is kind of a scary place. Lately, you flip on the news, geopolitics is everywhere. It's Russia and the Ukraine. It's the things that are going on in Israel. It's the economy in Europe, and especially China seems to be falling into its own problems. How do you think about all these big geopolitical events? Or do you not? It's really either in the charts or not.
No, I would say it's the latter. It's in the charts or not. So, I mean, put it this way. Market is a discounting mechanism. And sometimes it discounts things in advance, of course. But when things are a surprise, it discounts things quickly. And I think that's really the way to think about it. And what's interesting, I've noted, I mean, maybe there's a little bit of gold taking on its old-fashioned
safe harbor panic,
here.
A little apocalyptic currency.
Yeah, I mean, if you look at the research that, my colleague puts out, Paul Ciana, I mean, there's like a huge base on gold, that if it ever breaks out, it can go up a lot.
Right.
And the events of the world have enhanced that pattern a little bit.
So the question I have for your colleague is, hey, the past decade saw a lot of really crazy things happen, and gold, caught a little bit of a bid, but never really could get out of its own way. In fact, I don't think it got over the 2008-9 highs. What do we make of gold sort of forming this long? Is this a base or is this a top?
No, it looks like the mother of all cup and handles. The coin.
And
Bill
define
O'Neill
what a cup and handle pattern looks like.
Yeah, I'm going to define it because it's like it's Bill O'Neill coined it, right?
Right.
So the cup is this big rounding type of base. Stock rally. Sometimes it goes to a new high, which it did. So it did go above where it was
Briefly, right?
Yeah, a few times though. Now you have three probes up and a probe down. So you got the cup, and now you're forming the handle. And the handle's a lot shallower in terms of price decline.
Meaning buyers are coming in at higher
prices, meaning that there's demand for gold at higher prices. And if this technical formation works, I mean, and gold can clear those highs that have occurred over the last 3, 4, 5 years, then you got the pattern, and you can go much higher than where gold is today if we do complete that pattern. And gold was interesting too because if I put my equity hat on and look at gold the way I look at a stock, it tagged its 200-week moving average perfectly, rising 200-week moving average, which means secular uptrend. Even though gold is consolidated, it just lends more confidence that the pattern we're in now is more likely to break higher than break down. In just looking at just evidence-based type of technical analysis.
And you mentioned towards the end of 21 there were lots of warning signs. What did the technicals say about 2022? And let's revisit the June and October 2022 bottoms. What were the technicals saying then?
Sure. So we put out our year ahead for 2022. Buckle up! It's going to be a rocky year.
That's a pretty good call.
Yeah, I mean, I felt good about it. I mean, look, when you're looking at credit spreads peaking in the summer, you're looking at financial conditions, hitting their best levels in the summer 2021 and then deteriorating through the end of the year. When you're looking at the percentage of stocks about 200-day moving averages diverging for 6 months, a few other indicators I could point out, but it's a laundry list. And the S&P going to a new high in January, whereas the NASDAQ 100, NASDAQ comp topped out in November. It's telling you something's going on. And it just suggested to us that the rally that we've gotten from the COVID lows was at risk and we were entering into a corrective phase. And, we were targeting levels like 3,800. And we also threw out the 200-week moving average, which, when it eventually tested, it was like 3,490, around 3,500 on the 200-week moving average. So that was the pattern. And then we looked at, 2020 throughout the year, 2022, and you did hit a nice low in June. And you were able to rally, and then guess what happened? You stalled at a declining 40-week, 200-day moving average in August. And then you went down and undercut the June low. By a little bit. And I would say that was a nice retest of that low. There were some indicators. I believe the 14-week RSI had a higher low, meaning price momentum improved, even though the S&P went to a lower low. So that was a positive. I believe there were also fewer new 52-week lows. And the other ingredient was, that we just talked about earlier, versus June and November, you actually started to see the dollar peak and yields peak in October. So that helped the market stabilize and bottom out. So was there capitulation? Because that's what a lot of people, hung up on. We didn't get the capitulation in October 2022, and I would argue we did. The one indicator I would point to support two indicators. First, AAII bears went to the highest level, the most bears since early 2009.
That's pretty big level.
That's a huge level. So that's one. And the other one is that 3-month VIX versus VIX went below 1 late September, early October of 2022 to suggest to us that the tactical medium-term, momentum of medium-term sentiment did capitulate. So bears capitulated from retail investors, and the 3-month VIX versus VIX moved below 1 to suggest capitulation on that indicator. And the other thing that was very interesting about October of last year was that entering the month, we had 2 extraordinarily bullish breadth days, 90% up days on the NYSE in a row. And that helped solidify a bottom too, even though the first few sessions after that, it gave up all the rally from those 2 days.
Right. But
the market did find support with those days. So it was a very complicated market. Normally, when you get those two types of things, you just rip to the upside. But it's just so volatile now,
So let's sum up the secular view of the markets. We had a 34% downturn in 2020 during the pandemic. The rest of the year from those lows, I think we were plus 68%. The following year, plus 29%. And then we come into 2022. Where are we broadly? Have we been in a cyclical correction within a longer secular bull market? Is that how you're describing this? And if we are, how long could that secular bull market run for?
Yeah, so this is a great question. So first, the view of the 2022 correction was cyclical correction, secular bull market. We made comparisons with the Eurozone crisis in 2012, very similar to that. Also 2016 Brexit and the election that year.
Right.
And trade war in 2019. And one can even argue COVID 2020, similar setup where you went down, tested the 200-week MA, crossed above the 40-week, and then corrected to undercut the 40-week. You did it twice in 2012, once prior to the summer rally and once prior to the year-end rally, 2012. 2016, you hit it right when the Brexit vote happened, and then boom, ripped into summer rally. Fall correction, year-end rally after Trump got elected president in 2016. And the China trade war, two similar type of dips, one in the right ahead of the summer rally and one ahead of the year-end rally. So here we go. We had one in March, which was a little early, but it happened. You rallied above the 40-week, then moved below it, and then rallied back above it by the time you're in April, and you got a nice summer rally. And then right on cue, seasonality always says going back to 1928. Well, seasonality says going back to 1928, the worst 3-month period of the year is August through October, and that's exactly what's going on right here. We're getting that traditional correction, which usually precedes the best 3-month periods of the year of November through January. So I think that's where we are now. So we could very well be ending this cyclical correction soon if we follow seasonal patterns. Now, how long can the secular bull market last? Well, there's a financial advisor who helped me coin this term. I guess he was a Marilyn Monroe fan, the 7-year itch. So 7 years after the breakout of 2013 was COVID, and the market hit a spike low.
And 34% is normally considered a pretty substantial bear market.
I mean, the only other one in a secular bull trend that matched it was the 87 crash. And guess what? 87, 7 years after the 80 breakout. So 7-year itch there. I call it halftime. Not everybody knows Marilyn Monroe. I mean, I did a Jaws reference in one of my morning call appearances, talking about how the market needed to build a bigger base. We're going to need a bigger base. And sure enough, I bet you that trading floor probably Google, what's Jaws? Because think of the average age down there. But bottom line is this, and I just digress. So let me get back to what I was talking about. So the 7-year low, 87, bull market lasted until 2000. Then 57, 50 breakout in the S&P above the 37 high, and then you rallied into prior to 1957, had a correction in 1957, which was recession and a pandemic. So go figure. And then that lasted another 9 years. So, I mean, if I'm just saying, hey, midpoint 2020 from 2013, maybe it lasts until 2027. But some of these other bull markets lasted longer. Maybe I have to get a little bit of haircut given where inflation and interest rates are. I mean, that's quite a possibility.
Sure.
In fact, I mean, for order for the secular call to really work, I mean, let's face it, inflation does need to come down. And cannot spike, 10, 12%. I mean, if it does, that's not what happens during secular bull markets. The 1950s secular bull market started with, inflation high, and then it went down and stayed fairly contained. Higher interest rates, not what you want to see. 1980, sure, it started with interest rates double digits, but our friend Volcker, did what he needed to do and solved that problem. Rates went down. So, 10-year note yield is trending through 5.5, 5.75, and inflation's going back up. I think it's going to be very difficult for this secular bull trend to be sustained because it hasn't happened before. It doesn't mean it can't happen, but I can't find, any history to support that case.
Really interesting. So let's talk a little bit about what follows the worst 3 months of the year. You mentioned August, September, October. Tends to be seasonally the worst part of the year. I've seen all sorts of explanations for why that is. Harvest, people distracted with summer vacation, going back to school, whatever it is, the last 3 months tend to be pretty good. What are the odds that we're going to see Santa Claus come to Wall Street?
I hope they're pretty good. First and foremost, when we use traditional seasonality work, so traditional seasonality, what does it tell you? Everybody talks about sell in May and go away. But do you ever see anybody go on the media and say, hey, buy in October and stay? They don't, because that doesn't sell, right?
And it doesn't rhyme. It's true when it rhymes. That's the key.
Yeah, that's true. Buy in October.
The trend is your friend. If there's no rhyme there, it's no good. Except for the bend at the end, of course.
Yeah, but what's really funny about it is, I mean, November starts the best 3 and 6 month periods of the year for the S&P, which I think, going back to 1928, is really encouraging for those looking for the market to stabilize. But when you think about where we are in the presidential cycle, we're in year 3. So year 2 to year 3 has the best part of the cycle from fourth quarter year 2, which was last year around this time, through the middle of year 3. So, and we did that perfectly. And now we're doing
getting ready for year 4.
We're getting ready for year 4, but right here, right now, it's tough in year 3, August, September, October, November. So seasonality might be pushed into December. We could struggle into November because that can happen in the third year of the presidential cycle. So in the third year of the presidential cycle, positive Q4 performance is typically a Santa Claus rally event. So, and then the next part of the cycle calls for a choppy pattern into May of next year. But then you follow traditional seasonal patterns, summer rally, fall dip, and correction and rally after the election. And it doesn't matter who wins or loses. I mean, in 2016, everybody thought Trump was a disaster. Everybody thought Biden was a disaster, and the contested election was a disaster.
Both cases, market did well, right?
The market did well. So I think, granted, I mean that we're in an interesting period of time here where it may take a bit longer for the market to stabilize, but I do think if we follow, the pattern work, December should be good.
So let's talk about another sort of historical pattern, not quite seasonal. I've seen a lot of studies that suggest when the Fed finishes its rate hiking cycle, shortly thereafter, we're off to the races in the equity side. It almost feels like the market isn't sure if the Fed is done, and once the market is comfortable, hey, we're done raising rates, the next leg up can begin. Does that sound reasonable, or what are your thoughts on that?
I mean, it does sound reasonable. I mean, clarity around when that final rate cut's happening probably would be helpful. I mean, I think that's one reason why the market is struggling a little bit, because there's that last hike just sitting out there creating uncertainty.
Plus, you have a lot of Fed governors jawboning back and forth. It doesn't seem like there's a consensus there yet.
Yes, I mean, my dad was a bond guy all his life, and he told me FOMC stands for Federal Open Mouth Committee, meaning they talk a lot and sometimes confuse markets. Funny. And back in the day when he was trading bonds, they didn't tell you what they were doing either at the Fed meetings. You had to figure it out from price action.
They didn't even announce that. People don't realize when you talk about some people who've only been in the business for 10 or 20 years, the Fed didn't even tell you we're hiking rates. You would just have to see what would take place in the bond market. Suddenly it's like, hey, who's buying all these equities or who's selling all these bonds? You had to figure out what was going on.
I mean, we are spoon-fed, that's for sure. I mean, then I don't know whether that's a good or bad thing. I mean, again, information just comes at us so quickly digested. You got machines that help you digest the information and make trading decisions. But yeah, the environment has definitely gotten more complicated. I mean, my dad, when taking the train back in the day, he wasn't getting emails on the, he could actually play bridge with a few other guys on the train,
So let me ask you a related question to that, about the Fed spoon feeding us. Say what you will about Jerome Powell and the Federal Reserve. He said, we're going to raise rates, and he started raising rates. In fact, he said, we're going to raise rates aggressively to combat inflation. Now, we could say they were a little late to the party. They should have started a year earlier. But hold that aside. It seems like the equity market didn't believe the Fed chairman when he said, hold my beer, watch what I'm about to do with rates. Nobody seemed to believe him.
Well, I mean, I think it's good that the equity market was able to, obviously at first it corrected, but able to rally again because, again, people say, hey, they're increasing rates drastically. And I'm like, no, I would not. I would call it normalization of rates. I think that's
a fair
really
phrase.
What's going on. It's not, it is aggressively hiking. They did, but they got it to a more normalized level. So again, I mean, is it normal to get a return on cash investments? The answer to that question, I would argue, is yes. So this is the most normal environment we've been in a long time.
Which is kind of crazy to think about. The previous 2 decades were abnormal, and think about everybody who's, first started investing in these 20 years. You had a 10-year bear market, right, from 2000 to, I don't know, call it 2012, 2013. Is this normal, or is this normalizing? Where we may not quite be at normal yet, are we?
Well, we'll see. I mean, it takes time to really figure that one out, but I think we're a lot more normal than we were 10 years ago.
You mentioned different market cycles in the 50s and the 60s. You use a lot of historical references. How informative is going back decades or centuries? The world was so different, right. In an era of telegraphs and railroads. Can we really carry forward lessons from that era, from chart action to the modern world?
I mean, I think you can. The primary reason you can is because the dynamics of human nature and fear and greed haven't changed. Now, people will say, well, there's more mechanical trading these days with high-frequency trading and things like that. I'm like, well, who created the programs?
Right. Who's writing those algos?
It's human beings who created it. So, I mean, there is a human element touching all of that. So maybe if we're coming back in 10 years, 20 years, and the machines are creating things, then maybe we have a different argument to talk about. But one would think if the machines were working the market, it wouldn't be as emotional as it is. And yet, it is very emotional.
It very much is. It's funny. I read a book a while ago. I think it was published in the 1920s by Richard Wyckoff, How I Trade Stocks. And what was so shocking was, okay, it was about railroads and telephone companies, but you could swap in internet and technology, and nothing is different. It reads as if it was written last month. It's really quite fascinating. That is human nature, isn't it?
Exactly. Progress, I guess, is the term. I mean, maybe we fear, greed, and progress. And I hope progress continues. I mean, look, maybe the secular driver of this is the AI theme, or things like that. I mean, because every secular bull trend has some sort of theme behind it. You would think.
Give us some examples. I like the concept of that.
Well, obviously, I think the 50s was more of a build back after World War II.
Post-war, right? And for people who may not know their history, you had the build-out of the interstate highway system.
Yep. Eisenhower.
You had the rise of suburbia, the rise of automobile companies, and the commercialization of passenger air travel and the electronic industry. There were a lot of things that took place in the 50s and 60s that drove everything forward. Every time we have a secular bull market, do you see something similar to that?
There should be, yeah. I mean, I think so. I mean, because the 80s, I guess
technology,
the birth
telecom,
of the computer and things
internet,
like that.
Sure.
And then, yeah, exactly.
Mobile, you just that 20-year period saw a lot of new industries pop into existence.
And then when it gets too exciting, such as the tech bubble, that's when things change. And it doesn't seem like we're there now, because we talked about these indicators peaking out in advance of the market in 2021. I don't really have that here, as we're on this corrective phase, except for the percentage of stocks with 200-day moving averages. That does have the divergence. But credit spreads confirm the rally. Financial conditions confirm the rally. A lot of other indicators confirm the rally. So, there's, a little different than, say, 2 years ago at this point.
So I'm glad you brought that up. I want to talk about what you called the Magnificent Seven and compare it to prior eras. When you take the 7 biggest companies on the S&P 500, their revenues collectively are something like $1.8 trillion. Their profits are $250 billion. Put on your CFA hat for a moment and let me ask you, hey, they're a disproportionate part of the S&P 500 with good reason.
Right.
Is that a fair statement? We've never seen any group of 7 companies make so much in revenue and so much in profits. How wrong is it that these are, the darling stocks?
it might not be wrong. And quite frankly, I would argue that could very well be a factor of a secular bull market. And here's why. During secular bull markets, what outperforms? Large caps or small caps?
Large caps.
You know,
they're international. They have a broader reach. They have great access to capital.
Small caps graduate.
That's right. Graduate to mid caps. Mid caps graduate to large caps. So, large caps become big caps.
So, the interesting thing is, like, in the equal weight, had its best period during the 2000 to 2013 bear market for equities. Mm-hmm. So one would argue that having a greater concentration, not to the extent, maybe it's Magnificent 50, maybe it's Magnificent 100 going forward. I mean, that I would take that as a bullish sign if we went from the 7 to the 20, maybe even more. But you're rewarding the winners, and I guess that's capitalism for you in some regard, Mm-hmm. So
makes a lot of sense. Before we get to our favorite questions, let me throw you one curveball. You do both broad analysis and I don't know if I would call them just outright market calls, but you certainly share opinions about where we are and where we could go. What were some of your most memorable calls that have stayed with you? What do you remember most fondly, and what are you not so keen on prior calls?
Well, I mean, I think the secular bull market call has been a great one since.
What are the dates of those?
2013 mm-hmm. when we broke out, and 2012 we broke out in the S&P and the NASDAQ.
And 2013 on the S&P
yep.
above the 2000 and
1570s.
highs.
Yep. Exactly.
07 highs, yep.
And that was really the big call.
And a ton of pushback, right? I remember 2013, people were like, no, this is just a bear market rally and it's going to end soon.
Well, we did a radio show on that. I remember back in the day, you and me talking about it, and I was explaining, well, I mean, a big trading range, you break out of it, this is like 1950, 1980. It should continue for a while.
And it did for 7 years until COVID.
I mean, the call I want to forget, though, is being so bold up on value over growth entering this year because, quite frankly, it looked like a classic double top that supported the case for value to beat growth. And obviously that didn't work. So
that value did have a good couple, 21, 22, pretty good years compared to the prior decade. In fact, that might be the longest run we've seen of value underperforming growth until 21. Is that fair? Yes,
I think so. I think it bottomed out in 2006. So. And, one would have thought that you would have seen a peak in that, not that you have to sell all your tech names and buy all the value names because, that is obviously not what you want to do. But yeah, it was surprising that technical formation did not work. A nice classic double top formation on growth relative to value. A little bit surprising. And the NASDAQ stalled, not the NASDAQ, the technology sector stalled at its 2000 high relative to the S&P entering this year. And then, of course, when growth versus value didn't work, when value beating growth did not work and growth took the mantle leadership again, guess what happened? Tech broke out to all-time highs relative to the S&P going all the way back to 2000. Maybe that's the message we need to take here. As long as that breakout's in place, how is value going to beat growth?
Really, really interesting. All right, let's jump to our favorite questions that we ask all of our guests. Starting with, what have you been streaming these days? Give us your favorite podcast or Netflix, Amazon type of shows.
Sure. So in terms of TV shows and things like that,
sure.
I've been watching Loki on Disney Plus.
Mm-hmm.
Big Star Wars fan, so obviously I watched The Mandalorian, Ahsoka.
I'm way behind on Ahsoka, so no.
I will not
spoilers.
say anything. Yeah,
but the first couple episodes looked really interesting.
Yeah, solid show. I'm into all those superhero shows, even some of the gory and raunchy ones like The Boys.
The Boys was great, and the second season. There's a third season coming also.
I hope so. And now I'm watching this V University show or something like that with same concept, same people, mm-hmm. but young kids that are in school.
Oh, okay. I saw a preview for that. That looks interesting.
It's gory,
So was The Boys. Was totally gory.
Yeah, and then of course, I'm sitting there. Oh, this looks interesting. It's about kids, and
splat.
And I'm like, turned it on, and all of a sudden, oops, let's turn that off. My son was in the room. He wasn't watching it, but he was doing something else.
Right.
And I'm like, all right, this coming right off.
So if you like The Boys, there are two shows that were on Amazon Prime that you might like. I think everybody knows The Expanse was pretty popular.
Yeah, I didn't see that one yet.
It's a great sci-fi
and that's
series.
right up my alley too.
But something that's a little more eclectic and not well known was Altered Carbon. It was only 2 seasons. Amazing.
Yeah, last year I was into I binged Stranger Things.
How'd you like that?
Oh, I love that show because I was a 1980s Dungeons and Dragons kid. So and now I'm playing it now with my son, some of his friends. So COVID actually brought a few things out. You got back into some old hobbies. Which was kind of fun.
During COVID, we broke out all of the kitchen appliances and wedding gifts that just had not been touched. Like,
oh, that's fun.
Literally like the Yo Nana, things like that, where you're putting frozen fruit into this device and turning it into
that's so cool
to ice cream and the air fryers, and it's really funny. Everybody went to the basement or garage or a storage room and pulled out the stuff that had been gathering dust for years. It was that was the best part of COVID.
Yeah, I found my Dungeon Master's guide, my player's handbook with the duct tape holding it together. And by the time, my son, I taught my son how. My daughter played for a little while, but it wasn't her thing. But
right.
And now we're continuing I started a little club in town, so we got a few people playing every other Saturday. So it's fun. It was a good thing to do.
That sounds like fun. Tell us about your mentors who helped shape your career.
Yeah, sure. I mean, obviously all the people I mentioned earlier in the podcast, of course, my dad, Marianne Bartels, my boss at Wehrmar Huff, Stefan Haberer, very, very, helped me, steer, get into the fundamental side of the business, as far as like technical analysts and things like that, books I've read, I mean, mostly influential by John Murphy, Martin Bring, and Dr. Alexander Elliter. I mean, those are my go-tos as far as and Norman Fossbach too. I have that book, Stock Market Logic. I love that book. I
have that book. I've had that for a long time. It's really an interesting book. Since you mentioned books, what are you reading currently? What do you read for fun?
Well, I mean, right now, I don't want to sound too dorky, but it's related to Dungeons and Dragons. It's
what's the name of the book?
The Waterdeep Dragon Heist.
Waterdeep Dragon Heist. So that doesn't sound dorky at all.
No, it's a part of the adventure and stuff like that I'm running the campaign through.
But by the way, I know guys in our industry that you would never in a million years guess still do a weekly Dungeons and Dragons and have for like 20, 30 years.
Geez, sign me up. I'd do that in a second. Yeah, it's fun. No, but other than that, I mean, obviously, when I was in college, part of the English writing major is you had to take, literature classes. Mm-hmm. And my favorite literature classes was the epic hero. So it was The Hobbit, Lord of the Rings. Of course, I read The Hobbit prior to that class, but I read it again. I read some of the Lord of the Rings prior to that class. It was a lot of intense reading. I mean, it's Lord of the Rings. I can't even say it. The Silmarillion. I can't even say it. But
right.
And then also the Odyssey and the Iliad.
Sure.
And in high school, I read the Iliad in Latin.
You're not fluent in Latin.
No. It was high school, but it did help me out with the English language, so which was good. A lot of the words get derived from Latin, and and obviously German too. So I did take some German in college. Unfortunately, forgot most of that as well. But
that's really interesting. So let's jump to our final 2 questions. What sort of advice would you give to a recent college grad interested in a career in either finance or technical analysis?
Well, I mean, finance, I think, believe it or not, especially where we are now, creativity is very important. Also, curiosity is very important. When I was looking for a job in finance, coming from a different background, it was tougher, and I just didn't. I didn't really start making headway until I was up on the news, the Wall Street Journal, like consistently reading that for like a month. Then I was ready to go in and talk to people about careers to some extent. Obviously not an expert on anything, but just expressing the interest. But I would say
not professionally relying on the media for information, but to be able to have an intelligent interview and intelligent conversation.
Right. Because that comes up. I mean, because when we interview people, there's always, hey, did you read that story in the world? And most of the time people say, no, I don't do that. I listen to podcasts, but they still get the same information, similar information.
Not quite as in depth, not quite as, focused, but that's a good advice. Go in prepared and be able to talk about that you're up to speed and ready to start knowing what's happening. And
whenever I interview people, I always want to know what they're doing outside of business and finance, because I find that more interesting in some regards. Like if you have let me think like if they were a professional lacrosse player, not professional, a college Division I lacrosse player, that's kind of interesting.
Right.
It's like they know how to be part of a team. Some of those intangibles. So I would say, some of the intangibles and things outside, are interesting. I mean, somebody looking to get into technical analysis, I would say probably avoid that like the plague. Why? Are there a lot of technical analysts on the street these days? Probably not. You can count them on maybe two hands.
Really?
But I would say if you want to get a role in finance or as an analyst or as, a financial advisor, learning technicals will save you. It will help you a ton, but you're not going to be getting a role as a technical analyst. It's just, there's just not that many of them. And often they're just placed at the back of the bus. And as Ralph Acampora said, that's where they have the beer is. So I'm perfectly happily being in the back of the bus. But still, I would say, again, here's another quote. I don't remember who I heard this one from, but it says the CFA designation will get you a job, but the CMT designation will allow you to keep your job. So look, if you want to become a technical analyst and work at a bulge bracket research firm as a technical analyst, it's unlikely. I'm very lucky to be sitting where I'm sitting. It's like, and who knows how long it's going to last? You know what I mean? It's like, the business is tough.
Definitely, and it's gotten tougher on the institutional sell side because of the advent of either free or practically free trading.
But it's very interesting, though, because you run into a lot of folks on the institutional side that aren't technical analysts, but use technical analysis, and some of them, even pursue the CMT designation, which is a chartered market technician, the credential that's the equivalent of the CFA, chartered financial analyst, and they do it. I would say if you're interested in a career where you're going to be doing some technicals, obviously a trading desk type of role might be suited for that. An equity analyst would be suited for it. I know a few equity analysts that do not that they're making fundamental views based on technicals, but if they want to upgrade a stock and they look at a chart saying, well, I love the fundamentals on this company, but the chart looks like it can break below 50 and head to 45, maybe I should wait for that to happen.
Let me ask you a question that I love asking people who use both fundamentals and charts. If you're going to buy a stock, and in our hypothetical, you can only either read a fundamental research report or look at the chart, which do you do?
Yeah, that's obvious, because it's look at the chart. No question. Why? Because the chart reflects fundamental information. Bottom line. Look, what does the price reflect? It reflects, a little bit of the funny money from the high frequency trading, which we have no idea what that's all about. But it also reflects people's opinion on price action to some extent. But it actually reflects what fundamentals are to some extent too. So it's psychology and, what actual factual information is. It's discounting what the fundamentals are or will be in the future. So, I would say, you could have an analyst note saying sell this stock like it's unholdable, or, hard sell on this name. But you look at a chart and it looks like it's forming a double bottom. I may look at the chart more so than the fundamentals, because if the chart works, guess what that analyst has to do?
He'll eventually have to change that sell to a hold and that hold to a buy.
And if there's 40 of these analysts doing that over a period of time, guess where that stock's going to go?
Do you look at, the analyst collective ratings? How many buys, how many sells, how many holds?
I do. Yeah, there's a feature.
A&R.
Yeah, exactly. A&R, and also there's I have this recommendation ratio line on my Bloomberg chart I pull up every once in a while. Sometimes I find it really informative, other times I don't. But there are times when I can see a chart bottoming out and everybody hates it, and then it breaks out, and it's amazing how the analysts start to
right.
And you got a lot of time when that happens. So I would always gravitate towards a chart, and I would say it's really funny. Even folks that consider themselves fundamental investors do the same thing.
Huh. Really, really interesting. And our final question: what do you know about the world of investing today you wish you knew 25 years or so ago when you were first getting started?
Yep. I think the biggest thing I wish I knew when I was first getting started is, and you can say it in technical mumbo jumbo and fundamental mumbo jumbo, it's the same thing. An oversold stock can always become more oversold,
right.
And an undervalued stock can always become more undervalued. And when I learned that, I think things improved a lot.
Right.
I wish I knew that early on.
I learned that as cheap stocks can always get cheaper and expensive stocks can always get more expensive.
Right. Yeah, that's right. That's probably a better way of saying it.
Really interesting. Steve, thank you for being so generous with your time. We have been speaking with Steve Suttmeier. He is the Chief Equity Technical Strategist for BofA Securities. If you enjoy this conversation, check out any of the previous 500 interviews we've done over the past 9 years. You can find those at Apple Podcasts, Spotify, YouTube, wherever you find your favorite podcasts. Sign up for my daily reading list at Ritholtz.com. Follow me on Twitter at Ritholtz. Follow all of the Bloomberg family of podcasts on Twitter at Podcast. And be sure and check out my new podcast, At the Money, coming January 1st on Apple Podcasts. I would be remiss if I did not thank the crack team that helps put these conversations together each week. Rich Subnati is my audio engineer. Atika Valbrun is our project manager. Anna Luke is my producer. Sean Russo is my researcher. I'm Barry Ritholtz. You've been listening to Masters in Business on Bloomberg Radio.